All right, let's just jump right in. As we start looking toward 2026, the US financial markets are basically telling two completely different stories at the exact same time. It's wild. On one hand, things look incredibly strong, but on the other, the warning bells, they're ringing louder than they have in decades. So, in this explainer, we're going to try and untangle this massive contradiction.
So, here's the big question, right? This is the core puzzle we need to solve. How on earth can the US economy feel so strong and at the same time so incredibly risky? I mean, how can you have these powerful signs of life while the stock market is flashing signals that historically have screamed major downturn ahead? It's this exact paradox that's defining everything for investors right now.
And look, this slide just lays it out perfectly. It really shows you the conflict in black and white. Over on the left, you've got the real economy humming along. The Atlanta Fed's model is forecasting a super healthy 3.5% GDP growth for Q3 2025. I mean, that's solid. But then you look to the right and you see the stock market's valuation, measured by this thing called the Shiller P ratio, and it's soaring above 40. A number like that just screams speculative bubble.
Okay, so let's get into it. We're going to break down this economic tug-of-war. First, we'll look at the case for resilience, all the good stuff. And then we'll flip the coin and look at all that mounting risk.
So this is the number that's got everyone feeling optimistic, 3.5%. This isn't just a good number. A real GDP growth estimate this high is a powerful signal that the US economy has this really strong foundation. It's managing to resist all the pressure from higher interest rates, global slowdowns, you name it. This means real, tangible economic output is expanding at a very, very healthy clip.
And that big GDP number, it's not just some abstract figure on a spreadsheet. It's being driven by you, by me, by the American consumer. What people are actually buying, what we call personal consumption, is growing at a solid 2.7% rate. And that tells us something huge. Despite everything, people are still out there spending money. And that's the main engine of the whole US economy.
Okay, but now let's talk about the other side of the coin. Let's introduce the villain of our story. This is the Shiller P ratio. In late 2025, it climbed above 40. Now, that's not just a little high, it's a massive, glaring red flag. It basically suggests that the price of the stock market has become dangerously disconnected from what companies are actually earning over the long term.
So what even is this thing? Well, the Shiller P, sometimes called the CAPE ratio, it's designed to give you a much more stable, long-term view of market valuation. See, instead of looking at just 1 year of earnings, which can jump all over the place, it averages out the last 10 years of earnings and it adjusts for inflation. This smooths out all the bumps from the business cycle and gives you a much clearer picture of whether the market is genuinely expensive or not.
Now, you really have to pay attention to this slide because the history here is absolutely critical. A CAPE ratio over 40, well, that puts us in extremely rare and, frankly, very uncomfortable company. To find another time we were up this high, you have to go back to two of the most infamous moments in stock market history. The first, the absolute peak of the dot-com bubble in 1999, and the other one, 1929, right before the Great Depression. The historical lesson is crystal clear. Valuations this high have a really nasty habit of coming before major market corrections.
So you have to ask, right? If the market is so historically expensive, what in the world is driving it? Well, the answer everyone gives is artificial intelligence. But here's the twist. This isn't the same AI story you've been hearing for the past few years. The whole narrative has taken a dramatic new turn, which brings us to our next big idea, the AI scarcity engine.
See, for the last couple of years, the whole AI story has been about amazing new software, new models, and how quickly everyone's adopting it.
But that story is fundamentally changing. The new reality? It's not about software anymore. The AI boom is now all about the scarcity of actual physical hardware.
And we're talking about very specific bottlenecks here. There's a severe shortage of high-bandwidth memory, or HBM. There's a shortage of those advanced accelerator chips. High-speed networking gear is scarce. And get this, even the basic stuff like power and cooling infrastructure needed to run these massive AI data centers is in short supply. And because a very small number of companies control these key resources, they have incredible pricing power right now. And this quote from Nigel Green, the CEO of DeVere Group, just nails it. He says, AI demand is real and durable, but scarcity, not hype, is now driving the market narrative. And that's the key takeaway. The market's focus is totally shifted. It's not about the hype of what AI can do anymore. It's about the cold, hard reality of who controls the limited physical stuff you need to make it happen.
But, this whole AI boom isn't happening in a vacuum. It all relies on a strong economy. Which brings us right back to that contradiction we started with, and the third piece of our puzzle, the incredibly weird behavior of the U.S. consumer.
And this chart just shows you that bizarre disconnect perfectly. On one hand, you see what consumers are doing. They're spending money, driving a solid 2.7% growth rate. But then you see what they're feeling. And their sentiment, how they feel about the future, is in the dumps at 63.2. So people are out there spending like everything's fine, but they are deeply, deeply pessimistic about what's coming next.
And this isn't just a one-off bad month. The expectations index has been below this critical line of 80, a level that has historically been a warning sign for a recession for 10 straight months. What this suggests is that today's strong spending is pretty fragile. It could be funded by savings that are running out or by credit cards, and that means it could all just evaporate if consumers' fears about the future actually start coming true.
So what we have here is this uniquely American paradox. But is the entire world walking this same tightrope? Not at all. And to see a totally different path forward, we just need to look across the Pacific, to Japan.
This table just lays out the difference so clearly. In the US, the market is being driven by this speculative, kind of debt-fueled AI spending cycle, which is what's leading to that insane CAPE ratio of over 40. But Japan, it's a completely different story. Their recovery is being driven by fundamental, domestic changes, real structural reforms, actual wage growth for workers, and a central bank that's being very cautious about its policy. It's a totally different, and you could argue, much more stable foundation for a market rally.
So, where does all this leave us? Well, when you put all these conflicting forces together, the resilience, the risk, the AI scarcity, the weird consumer sentiment, you get this incredibly precarious balancing act for the market as we head into 2026.
So let's just boil this all down into 4 key takeaways for 2026. First, you've got the resilience versus risk paradox. The economy is surprisingly strong, but the market is priced at historically dangerous levels. Second, AI scarcity. The whole AI story has shifted to physical hardware, which is concentrating profits into just a few companies. Third, the consumer disconnect. People are spending money now, but they are really worried about tomorrow. And finally, number 4, diversification. In an environment this strange, looking at markets with different stories, like Japan, is more crucial than ever.
And that really brings us to the ultimate question, doesn't it? Is the market walking a tightrope between a genuine AI revolution and a massive speculative fall? Right now, the market is betting the entire farm on the promise of AI, and it's being funded by this huge debt-fueled investment cycle. But at the exact same time, it's balancing on a wire stretched over a historical valuation chasm. What happens if it looks down? That is the question we will all be watching in 2026.